world to buy more U.S. debt, fewer people may be interested in doing so. And here's the Jeff Yu part. If you expect the dollar to continue losing value, investing in dollar-denominated assets such as treasuries looks even less appealing. At the margin, Jeff Yu, that's not a good story, is it?
Well, it wouldn't be a good story if that's how sovereign wealth funds and reserve management work. So there is a difference between investing in U.S. treasuries and investing in dollar-denominated assets. I'm sure lots of reserve managers and wealth funds would like to up their stakes in a growing U.S. economy. So let's be clear here. There is a separation angle, but net, if you want to look at the short term, the inflation impulse, if you want to push for a weaker dollar, then that actually could import a bit more inflation, especially in the U.S. and especially if you look at how dollar renminbi has been performing.
Right.
So that on the margins doesn't help.
I don't want to say never, Jeff, but I would suggest we have never seen the double impulse on the goods-producing IS curve as we do with a tax cut and then with a budget boost. We've got a double IS curve boost. Can that get stimulus over 3% GDP?
3% is going to be a magic number. We're not really there yet. A lot will depend on how corporates react. If you're going to see the investment, if you're going to lift that investment impulse and then ultimately productivity, and the 3 number is more about trend growth. If we can get US growth, trend growth back up to 3 or higher, then that's a game changer for the entire global economy, not just now, but for the future as well.
Dan, do you agree?
That would be fantastic. I think the issue is the Fed, as far as I know, still thinks that the trend growth rate is 1.9, and that's absolutely crucial because they're making their decisions on interest rates based on the perspective that it's 1.9. We're probably going to be growing 2 3/4 this year. That's well above that potential. We probably need to be hiking rates more, and the market's kind of ignoring that.
Right, but so are you saying that there's a danger the U.S. is actually overheating?
Absolutely. Really, at this point, I think as we're well aware, did not need a big fiscal stimulus at this point in the cycle. We've got it. The Fed needs to react to that. They're going to be leaning into the acceleration in growth in order to keep inflation under control, which is fundamentally why we don't think this sell-off, in terms of it being sparked by inflation fears, will go too far, because the Fed is still there. They're going to prevent that from happening.
Right, but the sell-off, at what point does the sell-off actually make the Fed rethink the 3 hikes, and at what point does a U.S. dollar that's weaker actually force the Fed to hike more?
That is a scenario that still seems pretty remote to us. Certainly the chart that we saw earlier about how much further the market would have to fall before you get to the territory where you think about the spillovers from the financial market into the real economy. Really don't think that's particularly likely, but yeah, it's a scenario that could happen if you did see another 10% drop in the market.
Very good. It is a tumultuous time, and we'll continue forward. We're giving you extra data checks. The VIX back up near a 32 level this morning. Daniel Morris with us at BNP. Jeff Yu of UBS, thrilled they're with us today. Doug Cass will join later. We'll have a brief conversation with Mr. Cass. I'll give you a little bit of a tease. He put funds to work yesterday. The House begins to vote in Washington. Stay with us. This is Bloomberg.
This is Bloomberg Surveillance. Francie and Tom from London and New York. Tom, let's look at the global equity correction. Investors reeling from the biggest sell-off in 2 years. That has been very acute in China and Hong Kong. Now, benchmark stock indices have entered a correction. Investors bracing for possibly more volatility before the Chinese New Year. We're back with Daniel Morris of BNP Paribas Asset Management and Jeffrey Yu of UBS Private Banking. Jeffrey, when you look at the China market, it was down some 4 to 5%. Hong Kong was actually significantly lower. Is it just that the market dynamics are different, or why was the sell-off sharper over there?
I think there are some idiosyncratic factors as well. There's a big move in the renminbi yesterday, so there's some regulatory factors behind it. Talk of some loosening of capital controls, and as we know, the quanta framework in China, if there's capital outflows actually and the weaker renminbi, that's sort of going to hurt onshore sentiment. At the same time, some seasonality. We know liquidity tends to be a bit squeezed and heading into Lunar New Year as well. So that's there's an element there too. But Chinese growth forecasts are being revised higher. There's a lot of interest markets under position. Still, it's a good market that we like.
Is there anything that we should watch out for the Chinese market, Dan, or is it as Jeffrey was saying, just kind of a little bit more like technical stuff?
Well, I think what we're thinking a bit differently about China this year is actually we're expecting growth rate to slow, but a forecast more in the services sector and the domestic sector. So it is a bit of a replay of the new China, old China story. I think it's going to be a bit more important, that separation this year, given that we're expecting to see a slowdown in GDP as opposed to the acceleration that we saw last year. So I think that dynamic is going to be very important.
Daniel Morris, I think it's important for the record to get what your exogenous shock is. As we all know, you get a correction like this, you get the VIX collapse that seems like ancient news from 5 and 6 days ago. What's the exogenous shock that keeps you up at night right now?
Well, I guess you always have the risk of any kind of geopolitical event, and something that's almost inherently unpredictable, and the effects then on the market, how long it can last and how far it would go. I think that's when that's ever present.